For more, I'm joined by John Martinko. He's president of Drexel Hamilton. It's good to see you. Welcome.
Thanks, Kelly.
You know, I know you follow the IPO space quite closely.
Yes,
how problematic? Look, ironically, the multi-share structure companies are actually outperforming single share structures, but this is a big problem for them, isn't it?
Yeah, and that report put out by Goldman last week really gets into the fact that if you have multi-share class A and B, you might not necessarily be included without certain exceptions into their index and be indexed. And what you're giving up, according to that report, is access to $3.3 billion of passive fees to help put a bid to your company.
I mean, if you're not in the S&P, every day we have a new stat about how that's how you know, all the flows are going. So if you're these companies, especially the ones that have really stumbled out of the gate, does that put enough onus on you to make these kinds of governance changes? I mean, if this whole process wasn't enough to get you to make these changes, might this be a catalyst?
Right, I think you're talking about not even that process of being restricted from getting included in the index to access to those passive fees, but what we've seen recently on these valuations and the disconnect between the private going to the public and the dispute around having those extra voting share classes. I think every CEO should take a hard look before they go into their public filing. They know what they're getting themselves into as far as going public and having shareholders and giving up those voting rights. I mean, you are now under a very regulated industry. You should know by now professionally what you're about to get yourself
Although a lot
into
of so the Peloton CEO last week when he was on Squawk Box was asked about this, and he said, I actually have diluted my stake to such a point. He said it was 3 or 6% or something like that. He said, that's why I want this 10 or 20 to 1 structure. But he said, I'm asked about it about a quarter of the time. People will ask me about this. So should we let the founders maintain some control of these companies? You know, they are the ones who put their necks on the line here. How else do you bridge that gap if you want some control, but also want to make sure that your companies are in the S&P and that investors are rewarding?
So just if you back up a second though, when you're a VC incubated company like Peloton and you have in that segment 8 rounds of investing, you can exit not just by IPO, but you can exit through acquisition as well. So for example, I took a look, just did some lookup of Ring CEO, very popular.
The company that was bought by Amazon?
Bought by Amazon for north of $1 billion. That company culture and that CEO is still at the helm driving that business into his mission.
Well, that's probably the exception to the rule that most people believe, which is I'm setting myself up to be the next Instagram or WhatsApp, or there's a litany of other names, Oculus, where you know, they go in, they hang on for a couple of years, but ultimately they're sidelined as the new parent executes on their vision. Right. So I don't know if that's something that is feasible for most companies to say that they're going to get the Ring-like outcome here.
No, it's not going to be, all those outcomes are going to be different for everyone, but if you follow through on your thesis and your mission, your business plan, you should maintain some type of culture within your company. So
final question, especially in light of WeWork pulling now its registration. When they relist, and sounds like that's their plan in 2020. New S1, maybe a new ownership structure. What should that ownership structure look like, especially given whoever might be the new CEO at that point? What is seen as an exception? Should they just go 1 for 1 all the way? Or what do you think is the acceptable move here?
Sure, and just to reflect on that report, going back to what you highlighted, do you go back to 1 share equals 1 vote or not? So it's still going to be determined. I'm probably not going to talk too specifics on that just because of the exposure there, but any CEO, any management team does seriously need to consider those voting rights. And talking to some institutional, very large vanilla companies, they themselves look at those voting rights and the type of consideration for the float, for the percentage of ownership. They might be limited to the amount of capital that they can bring in their indication of interest to invest in that company.
Yeah, because they have their own.
So all things on the table, all things considered going into 2020.
All right, we'll see if it helps kind of improve governance structures. It'd be a good thing for everybody. I appreciate it very much. Thank you very much, John Martinko from Drexel Burnham.